Selling Hawaii property as a foreigner. The IRS wants 15% upfront unless you know these 3 loopholes. If you are a non-resident selling real estate in the islands, you aren't just paying tax on your profit. The government is taking a massive cut of your gross sales price before you even see a dime. Today, I am showing you exactly how to protect your equity and keep your money where it belongs. I'm Jason Wong, a Hawaii licensed real estate broker specializing in high net worth international transactions. Over the years, I have helped numerous foreign property owners navigate the complex intersection of US federal and state tax laws. This video is dedicated to providing clear, actionable insights for the global investor. Please keep in mind, while I am an expert in the Hawaii market, I am not a CPA or a tax attorney. This video is for educational purposes and should not be considered formal legal or tax advice. Let's get started. When you sell property in Hawaii as a foreign resident, you are hit with 2 distinct withholding requirements, FIRPTA and HARPTA. FIRPTA stands for the Foreign Investment in Real Property Tax Act. This is a federal law. Currently, the IRS requires a standard withholding of 15% of the gross sales price. Then we have HARPTA, the Hawaii Real Property Tax Act. This is the state-level equivalent. Hawaii requires an additional 7.25% of the sales price to be withheld. Combined, that is a staggering 22.25% of your total sales price held back at the closing table. It is crucial to understand that these are not the actual taxes you owe. They are prepayments or security deposits held by the government to ensure you file a tax return later. But for many sellers, this creates a massive cash flow crisis. Here is the part most people miss. The government calculates these percentages based on the gross sales price, not your gain. If you sell a property for $2 million but you originally bought it for $1.8 million, your actual profit is relatively small. However, without proper planning, escrow is legally mandated to send over $445,000 to the IRS and the state of Hawaii. Many foreign sellers assume they will just get it back when they file their taxes the following year. While that is true, you are essentially giving the US government an interest-free loan for 12 to 18 months. If you need those funds for your next investment or to pay off a mortgage, waiting a year is not an option. Furthermore, many sellers overpay because they fail to document their basis, their original purchase price plus improvements, which would have lowered their actual tax liability. There are 3 primary tax reduction strategies you can use to mitigate this. Method 1. The FIRPTA Withholding Certificate. The most common path for those with low capital gains is applying for a withholding certificate via IRS Form 8288B. Who qualifies? Sellers whose actual tax liability is significantly lower than the 15% withholding. How it works: you submit a packet to the IRS before closing, proving that your maximum tax liability is less than the standard withholding amount. Timeline: this must be filed on or before the day of closing. Pros and cons: it allows escrow to hold the funds in a side account rather than sending them to the IRS immediately. Once the certificate is issued, escrow releases the excess money back to you. The downside: the IRS can take 90 days or longer to process it. Method 2. Residency or use-based exemptions. There is a specific personal residence exemption for FIRPTA, though it is narrow. Who qualifies? If the sales price is under $300,000 and the buyer intends to use the home as a primary residence for at least 50% of the time for the next 2 years. How it works: the buyer signs an affidavit at closing. Pros and cons: if the property is between $300,000 and $1 million and the buyer uses it as a residence, the rate can be reduced from 15% to 10%. However, in Hawaii's luxury market, many properties exceed these price points, making this exemption less common for high-end condos. Method 3. Installment sales and tax planning. Who qualifies? Sellers who do not need the full cash amount immediately. How it works: by structuring the sale so you receive payments over multiple years, you can potentially spread out the tax recognition. Additionally, if the property was held in certain US domestic structures, like a specific type of trust or domestic corporation, FIRPTA might not apply in the same way. Pros and cons: this requires heavy legal lifting and advanced tax planning before the property ever hits the market. It is not a last-minute fix. If you are planning to sell, timing is everything. Apply for a TIN early. You cannot file for a withholding reduction without a U.S. taxpayer identification number. If you don't have one, start the application now. Gather your cost basis. Find every receipt for renovations, additions, and your original closing statement. Every dollar spent on the property reduces your taxable gain. Hire a FIRPTA specialist CPA. Do not rely on your general accountant back home. You need someone who understands U.S. non-resident compliance. Inform escrow immediately. Your Hawaii escrow officer needs to know your foreign status early so they can coordinate the withholding paperwork. What you should not do is wait until you are in escrow to start this process. By then, it is often too late to avoid the full withholding. Now, let's look at a $2.5 million Hawaii condo. Without any planning, your total withholding, FIRPTA and HARPTA combined, is roughly $556,250. That is over $500,000 sitting with the government. Now imagine your actual capital gain on that property is only $200,000. Your actual tax liability might only be around $40,000 to $60,000. By successfully filing for a withholding certificate, you could potentially keep nearly $500,000 of your own equity at the time of the sale, rather than waiting 18 months for a refund. The difference between a prepared seller and an unprepared one is often measured in hundreds of thousands of dollars. If you are a foreign property owner or an expat considering a sale in Hawaii, early planning is the only way to ensure a smooth exit. More questions? Let's connect and discuss. Until next time. Disclaimer: this video is for informational purposes only. FIRPTA and HARPTA laws are subject to change. Consult with a qualified tax professional or attorney regarding your specific situation.